I use this exact trading strategy to secure over $400,000 in funded trading capital. And I'm gonna show it to you step by step. I didn't copy it from anyone. I built it from scratch. And it's the reason I went from consistently losing to consistent profitability. If you're serious about leveling up your trading and getting funded, this could be your one-way ticket. Stick around, because by the end of this video, you'll have the blueprint too. All right, I'm going to be showing you my model, which is going to be a one-way ticket to profitability. This is a model I created on my own, and I'm very happy to walk it through you guys because I think that this could really revolutionize your trading. Now, before we get into this, if you liked anything you've heard so far, would love if you could just press that like button. Really appreciate it. Also, you can go ahead and subscribe. I know you're gonna like this video, so just go ahead and subscribe now. Press that notification bell as well. Leave a comment as well below about one thing you're grateful for this week. I always like to do that with my comment section. And lastly, there's a free Discord below where you can join, get a lot more value. You can ask me direct questions. There's free education there, and just overall place for you to become a better trader. Now, without further ado, let's get straight into it. So we're gonna walk through this process step by step. It's quite simple. This may look like a lot, but let me break it down. On the higher time frame, the first thing you want to do is establish your bias. What does this mean, Chike? Determine the overall market direction. Where do you believe that price is going to go for the day, for the next 4 hours, for the next hour, right? So you need to understand where is the overall market headed to. That will dictate what happens on a lower time frame. Now, in order to do that, you want to do what is called a top-down analysis, which means that you cycle through the daily, the 4 hour, the 1 hour, the 15 minute, and the 5 minute, and the 1 minute. You go through all those time frames and you look at what the price action is telling you on the chart as to whether or not where is price going to. One thing that you need to really keep in mind when doing this is that higher time frames will always trump lower time frames. What do I mean by this? So think about this way. The daily candle is comprised of 4 hour candles. The 4 hour is comprised of 1 hour candles, right? 1 hour is comprised of 15 and so on and so forth. So who's really the leader here? Well, it's whatever the highest time frame is. The daily, if it's bullish, it's going to be a bullish candle anyway. The 4 hour or the 1 hour candles are just telling the story of how it got there. So you want to ensure that whenever you're entering a trading decision, that the higher time frames are not telling you otherwise. I guarantee you, if you go back, for those who are a little bit more experienced, if you go back in the past 100 trades you've taken, I bet you at least 30% of those trades that you lost on are straight just because you didn't have the right higher time frame. So make sure that you dial in on the higher time frame. And what are some key higher time frames to really dial into? The daily, 4 hour, and the 1 hour. Okay, what's going to happen over the next 4 hours? What's going to happen in the next 1 hour, right? Especially if you're an intraday trader, that'll be really good for you. If you're more of a scalper, you probably wouldn't look really at the 1 hour, 15 minute. But if you like to trade throughout the entire day, you would like to catch large price swings, definitely the daily, 4 hour, and 1 hour are going to be very important to you. Now, intermediate time frame bias. What does this really mean? This is, before we talked about the why. Where do I think price is going and why, right? And that's because of the higher time frame bias. Now, intermediate time frame bias is really about how you get there, right? So higher time frame bias is, why are we going in this overall direction? Intermediate time frame is now, how do we get there, right? And so the 15 minute and the 5 minute, especially for those who are intraday traders, right? Keep in mind that you are trading intraday, which means that you are just trading throughout the day, right? You can hold your trade for a couple hours, okay? Maybe you're not just, or maybe like, even up to an hour, right? Capture large price swings. You're not just holding them for 5 minutes or 10 minutes, right? This is for people who are holding it for at least an hour or around 30 minutes to plus, right? To maximum a couple hours. The important time frames for you are going to be the 15 minute and the 5 minute, okay? Now, these time frames, when they align with the 4 hour, 1 hour, right, the time frames above you, there's nothing more beautiful than those kind of trades, right? Because it tells you that, hey, look, higher time frame, the daily could be bullish, but what if we're in a Judas swing right now? What I mean by that is price actually is moving in the opposite direction of where the overall higher time frame is going for the time being, maybe to retrace back down to a discount, or maybe to take out some liquidity before reversing and going overall in the market direction. You will catch the sweetest trades when that Judas swing has already happened and the intermediate time frames, 15 minute, 5 minute, are now returning into the direction where you anticipated the higher time frames to be going. Now, the next thing you want to establish is time of day. Now, price moves based on time. which means that if it's not the right time, price ain't going nowhere. Have you noticed that, around certain times, especially when market closes or certain times of the day where price is likely to be very choppy? Now, there are certain characteristics of each times of day that I'll say for a completely different series of videos. But one thing that you just need to keep in mind is that I generally want you to keep your trades, within these ICT kill zones, right? And what does that mean? There are blocks of time where price tends to have the most volatility and tends to move the most. So it's from 7 to 9:30, 9:30 to 11:30, and 1:30 to 4 o'clock. And this applies only for equity futures. Okay, so indices. So I'm talking about NASDAQ and ES. These times are pretty similar for Forex, but they're a little different. But generally, these are the times that you can use, even for Forex as well. And then lastly, entry model. Now that you know why price is going to move into a certain direction, how it's going to get there, and is it the right time for me to execute? Now you actually need the go sign, right? The entry model is the go. That is the green light. That is the, hey, this is time to press your button. Just because all the three things have aligned before doesn't necessarily mean that you are ready to go, right? And tap that button to execute. You still need to find a place to enter that's optimal. You need to set your stop loss and you need to set your take profit. And you can't do any of that without a model. And what I mean by a model is like an entry pattern that shows itself on the chart that now will be the green light for you to be able to take a trade. Now, I use the ICT22 model, and I will be going over examples of that right now. But at the end of the day, if you have the three components I mentioned up before, your entry model is actually the least important. Okay, you can use any entry model to enter, but it is why you're entering that really matters. And that's the three things that I mentioned before. So how about we go over some examples? Now, on the daily time frame here, you can see that price came into the lower half of this daily FVG-CIVI, failed to touch the consequent encroachment of it, and wicked lower after purging this high. So after purging this high and closing below it, we closed below this high over here after failing to touch the consequent encroachment of this daily FVG-CIVI. Those are two very bearish signals. So price is now telling you that we may be entering a sell model where price is going to start retracing against the buy side. Now on the 4 hour, you can see that after that move happened, we broke market structure here below this low, came back up into a fair value gap, and then ran lower again. Now after purging this low, we retraced back into a premium of this recent move, and we're inside a fair value gap. This is a pretty ideal area on a higher time frame to reverse from. We're also making a series of lower lows. So I know price is bearish. So what should I be looking for in a premium here? Shorts. 1 hour also seems to be aligned. Okay. There's a high here that got purged by taking out this high, and then price started to break down. So far, every time frame is telling us bearish. Now that we've looked at the daily 4 hour, 1 hour, we know that the higher time frames are telling us we're bearish. Now let's see if the 15-minute is also agreeing with that. Well, you can see after we took out that high that I just talked about in the 4 hour, we created a 15-minute bearish order block. We came back into that order block, failed to get through it, made new lows, rebalanced it, and then created another order block, right? So clearly order flow here is bearish. The 5-minute is also telling us the same thing. Now, I don't necessarily need the 5-minute to agree if I've already concluded that the 15-minute is telling me that we're bearish, right? Because higher time frames trump lower time frames. So I need at least a higher portion of the 15-minute or the 5-minute to tell me what the intermediate time frame bias is. For the higher time frames, you need, sometimes normally I would say, okay, well, the daily needs to be the captain of the ship. But if you're an intraday trader, a lot of times you could use the 4 hour. And the 4 hour, if that is bearish and the 1 hour is telling you bullish, trust me, you're bearish because higher time frames trump lower time frames. So yeah, I at least need the 4 hour to agree. But if you can't, signal a reliable bias from the 4 hour, you can use the 1 hour. But if the 4 hour is disagreeing with the 1 hour, that's a no-go. So anyway, we now know that the intermediate time frame here is all bearish. Now I just need to wait for a time of day. Well, look at the time of day. The trade here I'm going to show you is around here. It's around here. So you can see if you look here, it's between 1:30. It's past 1:30 now. So any point beyond this point right here, I can enter a trade. So let's go on the 1 minute. So now in the 1 minute is where I'm going to look to enter. So now I'm waiting for my 22 model. So what is a 22? Let's say you're making a series of lows, right? Making a series of lows, And then you come into a discount PD array, maybe like a fair value gap over here. Price goes there. And then what do? We break market structure above the most recent high after purging a low, and optional to be reactive from a PD array, but you at least need to purge a low right here, right? We came below that low, we purge liquidity, break up market structure, and there needs to be a fair value gap. Price returns back to fair value gap, runs higher. Now, if that's a bit confusing, let me show you a real example. So take it for a second and see if you can spot what I'm talking about. Make sure you're pausing the video. If you didn't pause the video, you're obstructing your own learning. So those of you who guessed this right here, you're right. This is the 22 model right here. Now, what do we have? We had a series of lows. We did have a break of market structure here. So yes, this is a buy side 22 model. But guess what? We are not looking for longs. We're looking for shorts. This is why you cannot just trust longs. You cannot just trust the 1 minute just because it's showing you a nice 22 model. You can't trust that. Higher time frames trump lower time frames. So that's why you see this happen. You have this high, it gets taken out by this high. So that's a purge liquidity. 1, 2, break of market structure. Okay, below this low, we broke it, right? And then, that shows that we're ready to move in the opposite direction. And then 3, fair value gap. That is the difference between this candle's low and this candle's high. When you just see body like that, there's only sell side. So that's a sell side inefficiency, buy side imbalance. Okay, that's what ICT calls it. We take out this low, we come back into it. Okay, come back into that fair value gap. And also, here's another tip. You can see that we come back just around that OTE part of the entry and back into a premium. So that's where my entry could have been at. I could have entered at a premium there. So that was somewhere around here. Stop loss goes above this high, and you can aim for some reasonable liquidity, like this low over here. That is a nice 1 to 5 R. Okay, this is a beautiful example of how all 4 things that I just mentioned align, and you can make tons of money. All right. Anyway, hopefully this was helpful. Make sure that you like, subscribe, press the notification bell, join the Discord, and I'll see you in the next video.